So you're looking to get yourself a mortgage this year? Well, I've got a few things you need to know about to make sure we avoid getting your mortgage application declined. Plus, if you stay to the end, I've got my top tip to make sure that you get your mortgage application accepted and you stand the best possible chance. So, you ready? Let's get into it. Hey everyone, welcome back to the channel. My name's Adam, I'm an expert mortgage broker. Today we're talking about mortgage applications and making sure we don't get your mortgage application declined. So I've got a few top tips for you, a few things that you need to avoid, a few things we need to know about. So as always, if you enjoyed today's video, if you find it useful, give us a thumbs up, subscribe to the channel so you won't miss the next one next week. Let's start with the biggest one then, the one that everyone kind of thinks about is credit score. Now, we need to avoid obviously having a bad credit score, but that's not the end of the story. So credit score is one thing, but I'm going to talk about credit score, I'm going to talk about credit conduct, because actually it's your conduct that's most important. People get hung up on what their score is. If you look on Experian or any of the credit providers, you'll get a score. And that is not the be all and end all. I've seen plenty of people with excellent scores, but actually their conduct isn't great recently, and we've come into difficulty. Equally, I've seen people with really bad scores, low scores, but actually there's nothing really on there that's causing a problem. It's just low. There could be a number of reasons why it's low. Some of those we'll get onto in a sec. And I've seen them get, perfectly accepted by, kind of mainstream lenders. So your score is not the be all and end all. It's your conduct that's most important. So the few things we need to avoid. We need to avoid having missed or late payments recently. Now, if you missed your credit card payment 5 years ago, that really is not going to have any effect on your mortgage application right now, if that's the only thing on there, so please don't worry about that. But in the last 3 or 4 months, last 6 months even, if you've missed payments or you've been late paying something, your credit card maybe, or your personal loan, that is going to have a fairly major impact on what the lender looks at. So if we go back a few stages to credit score, what is your credit file, if you like. It's basically a record. So it's a record of all of your financial commitments. Now it could be utility bills. Council tax, interestingly, isn't on your credit score. Random fact for you. But it's your utility bills, it's your mobile phone, it's your bank account, it's your personal loans, your credit card. Anything where there's an element of credit, so borrowing, or if you have to apply to get something, generally speaking, that's going to be on your credit file. And so your credit report is basically a history of how well you've managed all of those credit commitments. So if you take out a personal loan from NatWest, let's say, NatWest will tell all of the credit referencing agencies that you've got that loan, and then every month when you make a payment, they'll also tell them that you've made a payment, and it's all on time and it's all up to date. But if you don't make a payment, then they will also tell them that as well. So everyone then that looks at your credit file for new lending will see, well, you didn't pay your NatWest loan on whatever date it was. And that will influence whether a new mortgage lender is going to give you some money or not. You see, it's all about risk for the mortgage lender. Everything that mortgage lenders do and worry about is always about risk. Are you going to repay your mortgage? Well, if you didn't repay your NatWest personal loan, are you going to repay their mortgage? Or, if you couldn't manage to pay your credit card bill 3 months ago, does that put you in a good place for them to think and have the confidence in you that you're going to repay the mortgage? So that is why the lenders are, concerned about credit, not credit score, but your credit conduct and things. That's why they look into it in so much detail. So the things that are going to impact us, though, we've just covered it, missed and late payments. That's, if they're recent, that's going to have more of an impact. A couple of years ago, it's not so much of an issue. One credit card bill missed 2 years ago, it's not so much of a problem. However, if you keep missing things or you keep being late paying things, eventually that lender is going to get kind of fed up. They're going to say, right, you haven't paid this back, and they're going to give you what we call a default. And so a default is not good. A default is basically showing everyone who looks at your credit file, you did not pay this commitment back. And so that is going to affect any new mortgage applications we do. So if we've got default, the other big one is a CCJ. So if you get CCJs for things like parking tickets and memberships and things. If you don't pay a fine or you stop paying your membership, then you may well end up with what we call a CCJ. So last couple of things on credit score, the older things are, the better. So the more time you've got between now and when you kind of made the mistake or didn't pay or whatever it was, the more time we've got, the better. Now, after 6 years, things fall off your credit score. So if you had a default, let's say 5.5 years ago, because you didn't pay a Barclays credit card, or whatever it is, then in 6 months' time, that will drop off your credit score and it won't be visible to anyone. So it's only the last 6 years that we need to be concerned with. If you've got stuff from like when you were younger, it's quite common for people to come out of university or college or whatever, and they've spent a load of money and haven't paid their credit card and things. That's not ideal, obviously, but it is more common. But if 6 years then pass between then and when you're looking for your mortgage, it's not going to have an effect because no one's going to see it. There's one other kind of random little thing that does affect your credit score as well. It's going to help your credit score, and that's making sure you're on the electoral register. You're registered to vote. Now, you don't have to vote, that's up to you, but if you're registered to vote at the address that you live at and at the address that your bank thinks you live at, we want to make sure it all sort of ties together. If you're registered to vote there, then that's going to help your credit score. It helps the lender kind of see that you are who you say you are and that you live where you say you live. It's just another layer, and actually that does have quite an effect. So if you can get yourself on the electoral register to make sure you're registered to vote at your address, that's going to help your credit score and help your chances of mortgage success. So another thing we want to avoid doing is taking out too much credit before you do your mortgage application. So every time you apply for any credit, whether it's mortgage or loan or credit card, it's going to leave a footprint on your credit score, and we don't want to have too many of those because each lender that looks at that can't see whether it was accepted or declined. They just can see that you did a search or someone did a search, and if you keep doing loads and loads of searches, then that looks bad because it must mean that maybe you got declined. So we need to limit the amount of credit searches we have in the kind of 3 months or so before your mortgage application. So don't go and take out a load of debt before you do your mortgage application. The other reason for that is every new piece of debt that you have, every new commitment affects your affordability. So that's the amount you can borrow. So the more debt you have, I've done videos about this on the channel before, but the more debt you have, the less you can borrow on your affordability. Whilst we're on commitments, there's a big thing we need to avoid doing, and that's not telling the lender about all of your commitments. Now, it's easy to forget about things like student loans. So many people I speak to forget that a car finance is a commitment. You say, you've got any credit commitments? No. Any cars? Oh yeah, we've got car finance. It's car finance, a lease, a PCP, whatever type of car finance it is, that is going to affect your affordability. It's a monthly commitment, and so every monthly commitment gets factored into your mortgage application by your mortgage lender. So it's really, really important to make sure that we give the lender at the start an accurate picture of what your situation is and what you've got, because if we don't, they'll see it anyway. When you do your mortgage application, they're going to look at your credit score, so they're going to see everything anyway. There's no hiding anything. So when they see it, then they factor it in themselves, and then you could end up borrowing or being able to borrow less than you initially thought you could because you didn't tell them about your car loan. Okay, so that's enough on credit scores and debts and things. Let's talk about income. The next thing we need to avoid is not telling the lender about your income properly. And so it kind of maybe sounds a bit silly, but we see a lot of people where their income is made up of basic salary, but then it's quite common to have things like overtime, or bonus, or commission, and that could be monthly or quarterly, annually. There's other kind of income that we see as well in there, so we get things like your car allowance, housing allowance, all sorts of different pieces like that. So if you get paid anything other than just basic salary, the lender needs to know how much of each type of income you get, because they're going to take into account all of your basic salary. They're going to use 100% of your basic salary. But if you get overtime and bonus and things, all the lenders differ. Some take half of your bonus and overtime. Some will take all of it if it's regular or guaranteed. So A, going to the right lender is important here, but B, making sure you give them the accurate figures for the different types of income you've got, because I've seen it all the time, I've seen it so many times. Oh yeah, I've got my agreement in principle with Halifax or whatever, whoever, and yeah, they'll lend me this much, get your offer accepted, and then actually they come to us to do the mortgage application, and they can't, Halifax won't lend enough because Halifax will only use 50 or 60% of their overtime figure, and they've put it all in as one. So that does happen from time to time, so it's really important to give the accurate figures. So I said at the start I'd give you my top tip to make sure you avoid getting declined. Well, my top tip actually is using a mortgage broker. Now, it doesn't have to be us, obviously. We're really good mortgage brokers, but you can use anyone you like. But the really important thing is to use a mortgage broker, because the mortgage broker is going to know which lenders to go to straight away without too much, fussing and messing about. We're going to know exactly which lenders are going to be best for you to go to based on your credit score and your income and how your income is broken down and everything. And we know which lenders to avoid and which lenders to go to. So that is your surefire way of making sure your mortgage application doesn't get declined. So I hope that has been useful for you today. Don't forget to give us a thumbs up, subscribe to the channel so you don't miss the next video. If you want to get in touch with us anytime, there's a link to our website in the description below. There's also a link to book an appointment straight in our diary. So hopefully we'll speak to you very soon. If not, I'll see you next week.